Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
All right. Good morning and welcome to The Bigger Picture. You're with me, Danko. Now, the realization that China has succeeded in developing AI systems to rival the US despite heavy restrictions was a dramatic wrench to a narrative that had benefited US equities investors for the better part of 2 years. Now, bullish predictions for Chinese shares are piling up just as fast as analysts are lowering their expectations for US stocks. We're seeing the Hong Kong stocks rising to one-week high yesterday as China's key economic data beat expectations, pointing to a strengthening recovery in the Asian nation. But can that rally be sustained? Meanwhile, yet another key economic event that we're watching out for, it's the widely anticipated Federal Reserve meeting that's happening tomorrow. And the central bank is largely expected to hold interest rates steady when it announces its next monetary policy decision. Markets will be looking for any clues about when the central bank could cut rates again. So to break it all down for us this morning, I'm happy to welcome on the show with us Homin Lee, the Senior Macro Strategist at Lombard Odier. Good morning, Homin. How are you doing today?
Good morning. Thanks for having me.
All right. It's a pleasure to have you on. Thanks a lot for joining us today. Now, Homin, the Hang Seng Index has risen about 20% this year compared with a 4.1% loss in the S&P 500 Index and a 8.1% decline in the Nasdaq Composite. Now, the divergence between the indexes, it's become the most extreme since the dot-com bubble burst in 2000. So how are you reading into the rally that we're seeing in the Hong Kong markets and what's fueling the surge?
Well, we think part of this development is probably due to the extreme valuation divergence between the two markets. If you think about it, the Hong Kong market since 2021 regulatory crackdown in China has suffered quite a bit, especially in relative performance terms to the U.S. market. So when you have a hint of a slight improvement, both in terms of regulation and market environment, and of course the DeepSeek, the positive shock from DeepSeek, then it's a bit natural for the two markets to see a bit of convergence in the valuation. But at the same time, the root cause of that relative underperformance has been the fear about the private sector and how they can manage the new regulatory stance from the authorities, and to the extent that DeepSeek has galvanized kind of a national support for the private industries, I think that's also the reason why the markets have done pretty well. Our outlook here is that the rally has been pretty significant. So the fear factor has eased for sure, and it technically, the flows from the mainland investors into the Hong Kong market has been pretty strong. So in the medium term, that's going to be a positive factor. But in the background, you still have uncertainties about potential export controls and trade restrictions from Trump and the magnitude of the stimulus package from Beijing. So we're neutral on overall China complex, but we'll tilt toward the Hong Kong market where, you still have a bit of valuation advantage and sensitivity to potential positive catalysts down the road. So this is kind of how we're positioning on the market.
All right. Are there any specific sectors that you are focused on in this aspect?
So in Hong Kong market, obviously you have quite a range of choices, but we're focusing on consumer discretionary, consumer staples, and also technology, media, and telecommunication companies, because this is where the juice is in terms of potential beneficial impact from the accelerated capex that will likely happen in the tech sector and for the cloud services and the AI services. And on top of that, they tend to be more sensitive to a hint of improvement in the economy. So these are the sectors that we like, and we're focusing on select well-managed names in that space.
Fantastic. All right. Thanks a lot for that, Homin. Now, on the back of this surge that we're seeing in Hong Kong Stock Exchange is also discussing options to lower the threshold for investors to buy some of the city's more expensive stocks to stoke trading. Now, for example, if you were to buy shares of Chinese automaker BYD today, which are up about 35% this year, an investor would need about 177,500 Hong Kong dollars. That translates to slightly more than 30,000 Singapore dollars to enter at the minimum Lombard lot of 500 shares. So what do you see as some of the pros and cons of a lowered threshold? And does higher liquidity outweigh the cons of a smaller lot?
So this is in line with the trend that we're seeing in the region, right? Singapore had a similar change in the lot sizes a while ago, and China, as part of the capital market reform plan in late 2023, they also changed the lot sizes. The main idea is that you make the trading of outlots and single stocks much easier. The lots that do not fill into the minimum trading units of the exchange in Hong Kong, and maybe you could make it easier as it's done in the U.S., for instance. So it's in line with the budget speech given by the Financial Secretary Paul Chan, and we think it's the right direction. Now, there are some issues. If you, for instance, change the lot sizes and make the trading much easier, you'll likely have the surge of trading that has to be facilitated by brokers. But right now in Hong Kong, the brokers have to use something called, basically the trading channels, what we call throttle. And these channels, due to the infrastructure limitations, they cannot handle, say 1,000 trades per second as they are done in the U.S. So there's a deeper discussion to be had between, say, HKEX and the brokers about, potentially expanding the capacities for this. We don't know if there's a conviction for this and the willingness to commit money to that kind of expansion. But certainly it's being signaled. And meanwhile, Hong Kong seems to be also guiding for some sort of a mandate that the price of single stock trades same level as these lot trades, which potentially could give you some benefits in terms of not touching the existing ecosystem that's based on the minimum trading units of the current ecosystem. So we'll have to see. But so far, these are indications, but at least it's in line with the policy speech. So we'll see how it goes.
Yeah, certainly it's quite encouraging to hear how they're improving, or at least in terms with improving liquidity within the market. Thanks for that, Homin. Now, let's talk a little bit about China as well, because sticking to the theme of China, they've also recently announced a special action plan to boost consumption on Sunday in a bid to prop up domestic consumption in the world's second largest economy. So the wide-ranging release outlined several steps, like taking multiple measures to stabilize the stock market and develop more bond products suitable for individual investors. Now, what does this mean for its sluggish consumer landscape and stock market, and how may investors play into this narrative?
Well, so our takeaway here is that in terms of rhetoric, it was definitely supportive in the sense that it gives you the correct diagnosis of what's weighing on China's consumption. So it, for instance, identifies the stabilization of the stock market and the property market as a key kind of element for stabilizing consumption down the road, and also pledges more support for the consumption of consumer durables. And we think it's potentially a signal that they'll consider maybe additional what we call trade-in schemes, these incentive schemes for the consumer durables, right? Smartwatches and electric vehicles and et cetera. And also, the study, gives you kind of 8 different dimensions of support for consumers. Focuses on, demand side instead of the supply side. So definitely the noises are right, and I think quite helpful. However, it does, we don't really have additional fiscal commitment to make these programs work. And there is an idea of, subsidy schemes for fertility. On a limited basis right now at the local level, the cash transfer schemes, depending on the number of kids you have, infants you have, these schemes are being tried. So a city in Inner Mongolia or in Shenzhen, they're kind of exploring these ideas. So, you can certainly expand these programs at the national level. But we still don't have a national fiscal resources, mentioned for this. So in terms of the rhetoric, quite supportive in direction. They'll probably have to do more. We are penciling in possible addition to trading schemes and fertility subsidies maybe in the second half of this year. But if that's true, then we'll likely have a slightly better consumption this year compared to last year. But, given what's been announced so far, not a game changer.
All right. Thanks for that. Now, Homin, let's shift our attention over to the U.S., where the widely anticipated Federal Open Market Committee is scheduled to meet tomorrow for its second monetary policy decision of the year. So what can we expect from the widely anticipated meeting, and what's your forecast for the policy path for the remainder of this year?
So the U.S. data have been actually pretty weak in the first quarter. If we are estimating that we're probably tracking slightly less than 1% growth in the first quarter because the consumption indicators have been pretty soft. But we still don't think the Fed will move in this meeting because there are some lingering worries about the Trump policy and its potential impact on inflation, which is not completely on target yet. So our guess is the Federal Reserve will reveal its thinking on Trump policy through the quarterly update of macroeconomic forecast, which is done on a quarterly basis, right? And at March is the window to do it. But our thinking here on the Fed's trajectory is they'll probably do 2 more cuts, maybe on a semi-annual basis, 25 basis points each, and that will bring the top end of the Fed fund target range from 4.5% currently to 4%. But that's probably the best they can do. And afterwards, maybe if you think about the possible macroeconomic context at the end of this year, inflation will actually start rebounding again due to the impact of tariffs.
Yeah.
So bringing the rate down to 4% is probably the farthest they can go, and they will likely signal this in the upcoming meeting. And for that reason, we think the market pricing for 4 additional cuts is a little excessive.
Yeah, certainly quite treacherous times we're in now, especially in line with Trump's policy tariffs. Let's now shift your final attention over to your thoughts about what's on your radar in the global markets front, and what will you be watching out for the next few weeks, just very quickly.
So obviously in the next few weeks, we'll have the full details of Trump's supposed reciprocal tariff policy announcements. So as you know, the White House is waiting for America First trade policy reviews from a bunch of different departments in the cabinet, and those reviews are supposed to be submitted to the White House by the 1st of April. And after that, the Trump team will release the framework for reciprocal tariff, and that's still a main event for the market because this will likely the main strategy for all the tariff-related communications going forward. So that's going to be the key issue. On our side, the fiscal bazooka that's been considered in Germany and at EU level, that's certainly a key development we need to watch because first time that the region is getting a fiscal support like this and has major implications for the currency markets, especially on the euro and the bond yields in the European region. And on a maybe on a tangentially related note, you also have a bit of a rise in yields in Japan, and that's creating a bit of discomfort in the capital markets. But our view is that it's a manageable spike so far, and we do think Japan will be one of the few central banks this year who will actually raise rates in the remainder of the year. So these are the kind of key developments to watch.
Okay. All right. Thank you so much for this comprehensive breakdown of markets, Homin. Thanks for joining us this morning.
Thank you so much for having me.
We've been speaking to Homin Lee, the senior macro strategist at Lombard Odier, talking all about Hong Kong markets and what to expect from the US federal meeting that's set to happen tomorrow. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.